If this strait shuts down, 20% of the world's oil disappears almost overnight. Every single day, nearly a fifth of global oil flows through a narrow passage between Iran and Oman. It's called the Strait of Hormuz. At its narrowest, this critical lifeline shrinks to just 21 miles, with shipping lanes only about 2 miles wide. One single miscalculation here could trigger a global conflict and send energy markets into sudden panic. The Persian Gulf is home to the world's largest oil producers: Saudi Arabia, Iraq, Kuwait, Qatar, and the UAE. Roughly 20 million barrels of oil move through this corridor every day. That's 1/5 of global consumption. While some countries have built pipelines to the Red Sea or the port of Fujairah, these can only carry a fraction of the oil that normally travels by tanker. The world remains trapped by this narrow gateway. Look at the map again. At the northern tip of Oman lies the Musandam Peninsula, a rugged mountain fortress. In several places, the distance between the Persian Gulf and the Gulf of Oman is surprisingly short. This raised a brilliant idea. Why not dig a massive canal straight through the peninsula? A $100 billion shortcut that allows ships to bypass the geopolitical trap of Hormuz entirely. But the terrain tells a different story. Musandam is part of the Hajar Mountains, one of the most rugged landscapes on Earth. Sharp limestone peaks rise dramatically, some climbing more than 2,000 meters above sea level. Building a canal here would not mean dredging sand. It would mean blasting through entire mountains to accommodate very large crude carriers. The cost could dwarf the $5 billion Panama Canal expansion many times over. But here is the key point. The first closure of Hormuz usually happens in spreadsheets, not at sea. If risk spikes overnight, insurers immediately raise war risk premiums to impractical levels. Within the first 24 hours, some coverage is paused entirely. Shipping companies do not operate on hope. They operate on risk calculations. Even if physical transit is not fully stopped, effective capacity drops because the cost and risk of moving cargo explodes. We see congestion at anchorage points and a massive repricing of global risk. By 72 hours, the system attempts to adapt by rerouting tankers around the Cape of Good Hope at the southern tip of Africa. This is not just a detour, it is a structural disruption. This route adds up to 2 extra weeks of travel and over $1 million in additional fuel costs per ship. As diesel powers global logistics, these rising costs cascade across entire industries. By week 2, the effects become personal. Inflation hits the price of food, aviation fuel, and consumer goods. From New York to Tokyo. This reveals a deeper truth. Global shipping depends on confidence. When confidence disappears, routes change, and the system shifts from optimizing for speed to optimizing for survival. This is where we see the Iran paradox. For Iran, Hormuz is a powerful lever to pressure rivals, but it is also their own economic lifeline. Closing the strait means cutting off their own ability to export. In this high-stakes game, there are clear winners, alternative suppliers outside the region, and massive losers, the Asian economies of China, India, and Japan, who remain trapped by this narrow gateway. In the end, the Musandam Canal represents a dream to redesign geography itself, to bypass one of the world's most fragile bottlenecks. But reality is stubborn. Mountains are difficult to move, and politics is even harder. This reveals a deeper truth of our modern world. Global trade does not run on open oceans. It runs through a handful of narrow corridors that quietly keep the entire economy moving. This is the strategic reality of Hormuz. It is not just water between two shores, but a concentrated global dependency. As long as the world runs on fossil fuels at scale, the chessboard stays set, and small shocks here will always become very big consequences, very fast. Geography is permanent. Our systems are only guests in its landscape.